Good afternoon, everyone. This is Damon Lester, president of NAMAD. I hope everyone had a great, safe, and enjoyable weekend as much as you could, being on lockdown, particularly us here in the Maryland, DC, Virginia area. We are still 100% locked down. So I want to thank you all for participating in our webinar series. Today, we have definitely a special guest that will provide us some insight on the state of the auto industry. And with that being said, I would like to present JP Morgan Chase and Mr. Ryan Brinkman from Chase. Please hold your questions until the end, and you can use the chat feature. Thank you. Ryan?
Great. Thank you, Damon. Yes, I'm the Automotive Equity Research Analyst at JP Morgan. Later, I'll be inviting on to the call Rajat Gupta, who covers the auto dealers for us. You can see on page 2, we thought to come with this agenda today. A lot of material to walk through. That being said, we're going to try to move through it rather quickly. If there's any topic that interests you or you wanted to explore more in depth, then we can address that in the Q&A. But we thought to come out at starting with sort of a macro update. What's the latest with regard to the various different metrics measuring the health of the auto industry, with a particular focus on the U.S. relative to inventories, sales, segment mix, incentives, average transaction prices, used car prices, what's happening there, et cetera. A little bit on what's happening with production of vehicles in North America and around the world, commodity prices, et cetera. Then I thought to provide, while maybe of a little bit less interest, at least a cursory overview of how we're thinking about the sector in terms of stock picking, which is, after all, our day job. I may skip over the section that discusses some of our most recently evolved views, but we've been saying that we prefer the aftermarket of the industry, including auto auctions and parts distribution, et cetera, more so than tires, although tires are still better positioned than suppliers, including because they benefit because 68% of the cost to produce a tire, the raw materials, are based on the price of oil, and also because of the aftermarket exposure, a little bit less cyclical. Suppliers, we say, are better positioned than automakers, including because they have counter-cyclical working capital, which tends to smooth out the impact on cash relative to EBIT. Automakers we're pretty concerned about, including because of very significant working capital headwinds and because of greater operating leverage, more fixed costs, et cetera, less ability to flex costs down with lower demand. And then worst positioned of all are rentals. We've actually been pretty.
Uh-oh, there you go.
Do we need to start over? I just got the message the broadcast just started.
Yeah, just welcome everyone. Good afternoon. This is Damon Lester from NAMAD. We want to welcome Chase, just in case you did not hear me earlier on. I'm not sure what just happened, but we want to welcome Chase Automotive to provide us with the state of the auto industry. Please welcome Mr. Ryan Brinkman.
Great, thanks. I'd mentioned that I'm Ryan Brinkman, the U.S. Automotive Equity Research Analyst at JP Morgan. We were looking at the agenda slide on slide 2, just basically saying we want to come at you with some of the latest macro metrics as impact the industry: inventory, sales, segment mix, incentives, average transaction prices, used car prices, what's happening with the U.S. industry, a little bit of the global context as well, a little bit on how we're thinking about positioning ourselves. We are stock picking analysts after all. We've been saying we prefer the auctions and the aftermarket because they are less cyclical, more so than tires. Tires are still roughly 80% aftermarket, so that will help them. Also, 68% of the raw materials used to produce a tire are in some way linked to the price of oil, so that will benefit as well. Suppliers are not as attractively positioned to tires because they are more cyclical, being linked to those automakers. That being said, they should fare better than the automakers because they have counter-cyclical working capital, which should smooth out the change in cash relative to the change or decline in EBIT. Automakers we're quite concerned about because of the very large working capital headwinds and also because of the greater fixed cost nature, less ability to flex costs down with demand and revenue. And worst of all positioned are the rentals. We've been pretty public. We think one of the 2 rental car companies we cover, Hertz, is likely to go bankrupt, or if not, then a significant out-of-court restructuring that materially impairs the equity. And even if they did soldier on, we think it would be a very unattractive investment there. Later on in the call, I'll be inviting on Rajat Gupta, who covers the auto dealers specifically for us, and they definitely fall on the left-hand side of the screen here, probably between the aftermarket and tires as being, while they are profoundly impacted, of course, one of the better positioned within the supply chain, within the greater automotive ecosystem. I may not go through it in great detail, but we did have some information there for you relative to our recent upgrades of the aftermarket and downgrades of the rental, really just reiterating what I ran through. And then if there's time, I'd like to go through our car sharing counterpoints section. We've been pushing back on the idea that there is this fully autonomous, completely car sharing future right around the corner. I think it may be impinged upon even more so by this hesitance for sharing, right? This is about shared mobility given coronavirus. May talk a little bit about too how we think coronavirus impacts the other big secular theme in the industry beyond autonomous mobility, which is electrification. I think it complicates electrification, including because of the decline in oil and gas prices. Now, if you look on slide 4, if Damon, you could navigate us there, this is a big picture overview of SAAR, or the seasonally adjusted annual rate of sales in various different countries around the world. And you see the extraordinary decline that we had to 8.6 million in April in the US, which is the lowest that we have on record going back to the early 1980s. The most we dipped to in 2008, 2009, I believe it was in March or April of 2009, was about 9.1 million. And you might recall we did 10.4 million for that full year. So it is a bit of a come down here. Coming into the year, we 5 million sales, which would have been down 3% versus the 17.0 million last year. For comparison purposes, we did 17.55 million or 17.6 million in 2016. So we're really calling for a 20% decline this year, as opposed to at the start of the year, we were only thinking about a 3% decline. Furthermore, if you compare the peak to trough of 17.6 million in 2016 to the 13.5, that would be a 23% decline, which is incidentally the average decline that we've seen in the auto industry since the invention of the automobile. I think if you just look on page 5, the only thing I really want to draw out here is that already the world was in a bit of a downturn. You can see China auto sales were down 8% in 2019, and that had been dragging on the global automotive industry. A little less important for North American focused dealers, but things weren't, especially rosy from an automotive manufacturing and supply perspective before this crisis even hit. If you look on page 7, did want to highlight a couple things here, including the average light vehicle age, which has increased from prior to the 08-09 downturn at 9.6 years to currently we think about 12.2 years. This should relatively insulate us from the worst of the decline. I think that the fact that we fell 40% just recently back in 08-09, and there has been the subsequent increase in light vehicle age, I think it does speak to the unlikelihood, if that is, or to getting a similar type decline this time around as back in 08-09. I also think that the 08-09 downturn, it being 40% compared to the average 23%, was exacerbated by the irrational removal of automotive credit, which we do not expect to be removed this time around, including because no investor lost any money in automotive ABS as opposed to, mortgage-backed securities back in 08-09. So the downturn is likely to be a little bit more typical. This increase in average light vehicle age, I don't want to feel too comfortable about that as providing a backstop for us, though, just given, being cognizant of the fact that there has been a substantial increase in vehicle longevity and durability. I think not to the extent of the increase in light vehicle age. I think some of that related to austerity, et cetera. I guess pointing out on slide 8 too, where you can see graphically depicted on the top of the page the decline in SAAR, the precipitous decline, but also the evaporation of the fleet element of the SAAR. Again, less relevant for dealers, of course, given that fleet customers generally purchase directly from the manufacturer, at least when it comes to daily rental, which is over half of fleet, daily rental has disappeared from the market, and we do not expect to be purchasing any vehicles over the next several months as they work to aggressively defleet. On slide 10, I did want to point out there has been two recent phenomena relative to segment mix. On the upper right-hand side, you can see the large pickup category having shot up to essentially one of every four vehicles being sold. I mean, 16% used to be a solid number. Overall, and we peaked full-size pickups as a percentage of total sales at 16% in 2006 during the housing boom, et cetera. Since then, we've kind of bounced between 12.5% and 15% of light vehicle sales being full-size trucks, and that shot up to 22% and 26% recently. We think that this is a phenomena of the fact that, as Damon was starting the call saying that, DC area is locked up, I think till June 10. I think New York is even longer, and LA. But you know what? The interior of the country is relatively more open. I see Texas is reopening, but really I think what's been driving sales are like the plain states, places like Wyoming and Montana and North Dakota really haven't been shut down. And guess what? They disproportionately buy pickup trucks there because of farming and because of the energy economy and so forth. Now, the opposite of the trend in pickups. Oh, and I think the pickup truck trend will be important to keep in mind when we start to look at incentives and transaction prices in a moment here. But at the bottom of page 10, too, the EV mix, you've seen a plummeting in the percentage of vehicles sold that are battery electric vehicles, hybrid vehicles, plug-in hybrid vehicles. Now, again, some of this could be because the coastal regions of the United States are where these vehicles are more popular. So some of it is certainly geographic dispersion, but I don't want to discount the idea that electric vehicle demand may now be, I don't want to say structurally, but for certainly a good time might be, experience some headwinds as a result of the fact that oil and gas prices are now so much lower. So I don't think that the price of gas mattered much to a Tesla Model S or X buyer or an Audi e-tron buyer. But when you start talking about the Nissan Leaf or the Volkswagen ID3 or a Chevrolet Bolt, I think it starts to become more relevant. On slide 11, I wanted to highlight the inventory situation and just how much this has blown out. And we do have to be concerned here about the fact that total industry days on hand supply at the end of April was 121 days. I'll allow for you that the denominator of the equation, the average daily selling rate for April, was clearly depressed. And we do expect, I don't want to say a rebound, but there's anecdotal evidence to suggest that May sales will be better than April. So that will come into play. And also the numerator of the equation, the total vehicles outstanding on dealer lots is going to be coming down as well, given that we expect to sell more vehicles than we produce in May. The Detroit Three are incidentally only starting their factories today. They've been shut down since the third week of March. And, they're not going to be at full capacity because they're retraining workers on social distancing and new safety measures being put into place. And the supply chain needs to come back up to speed. There's some kinks in the supply chain when it comes to parts being delivered from Mexico. You see that it just brought down the BMW plant that had restarted in Spartanburg. So, we think that the industry at the end of May will still be in an over-inventoried situation, but it won't look as bad as it did in April. And what we've been hearing from the manufacturers, from GM and Ford, is that they actually have spot shortages of vehicles in the parts of the country where the coronavirus restrictions have been less. And it'd be great if they could transfer some of those vehicles from New York to Kansas, et cetera. I don't know that they have that ability. And so what they're going to be doing is just focusing the restart of production on replenishing those dealers that have seen declines in inventory. On page 13, the trend in incentives, you can see this is clearly increasing a lot, up 26.3% year over year in April. That is the largest such percentage increase we've seen in a long time. I think, though, that it needs to be put in the context of what we were talking about with the segment mix, because full-size pickup trucks, you'll see they've been putting upward pressure on transaction prices. And the full-size pickup truck category, because it's a domestic manufacturer category, and just because it's a higher ATP category, and so as a percentage of ATPs, the incentives are less as a percentage. So, but in dollar amounts, the incentives for those categories tend to be higher. So clearly underlying incentives are increasing, and that is a negative for manufacturer profitability, but it's probably not as dire as the picture looks, up 26%. And then as mentioned, well, you can see that graphically depicted on page 15. I think that's interesting. You can see from roughly 2013 to roughly 2020, we have increased the average incentives by almost $1,500. And yet, if you look at page 16, average transaction prices, which are calculated after the impact of increase in incentives, have still managed to increase over that time. In fact, they've managed to increase about $4,000 over that time. If you throw out the April number, they're up $6,000, and up 5.4% year over year in April. Extremely strong. We've never seen that type of an increase before. Again, I think sort of on an underlying basis, the transaction price is not increasing, but because of the segment mix, that is obfuscating it and causing it to be higher overall. It's not, for nothing. F&I dollars, are benefit from that, et cetera. On page 17, you can see the cost, the weighted average cost of commodities that go into a car is in a deflationary cycle. That is a bit of an offset to the doom and gloom. But on page 18, we have a real problem in the industry. Don't look at the NADA figure because that is 1 month delayed relative to Manheim. But the issue here is that used vehicle prices are falling at a record pace. This is on slide 18. So we went back, we looked from September of 2007, which is when used vehicle prices peaked in the last cycle, to December of 2008, used vehicle prices fell by 15%. But it took 15 months for the prices to fall 15%. And what we saw here was an 11.8% sequential decline just in the first 2 weeks of April compared to May. So we've seen, a year's worth of decline in Great Recession, used vehicle prices too. We've seen that compressed in just a couple of weeks here. And that's really what's causing the bankruptcies of, bankruptcy of Hertz. I don't say Avis we think is going to make it, but that's what's so challenging the rental car industry right now. Yes, demand is off 70, 80%. 2/3 of their traffic comes from air travel, but the bigger issue, unfortunately, is just the situation that they have to top up these ABS securitizations because the value of the vehicles has declined so much. It's costing them $700-800 million just in the second quarter of cash that they need to contribute there. Maybe we'll skip over some of these international trends over the next few pages, but I did want to highlight on page 23 just the distress that the global auto industry is experiencing right now, and as is impacting the automakers that you interact with in North America. So in the first quarter of the year, the way to read this in sort of the middle of the chart is that on a year-over-year percentage basis, global light vehicle production declined by 23%. It made for a very difficult first quarter earnings season, which just concluded last week. But the second quarter is going to be far worse for a couple of reasons. First of all, the global decline will be 48% year over year instead of 23%. And secondly, the first quarter decline was really led by China, down 46%, you can see there, whereas they'll be only down 2% in the second quarter is the outlook. But North America and Europe, which matter so much more for the domestic manufacturers, at least for GM and for Ford, down 70% and 65% respectively in the second quarter. That is just going to really challenge them. And another big takeaway from this slide, I think, is that if you look at the column for 2020, China is only expected to fall 15% this year. Can you believe that? Of all the major regions in the world listed here, China is expected to decline the least as a result of the coronavirus crisis. Go back to January, even into February, we thought this was a Chinese problem, right? In fact, they'll decline the least. It has impacted the world more outside of China. Look at who's declining the most is Latin America, which has been disproportionately less impacted by the virus. Brazil has been impacted, but the other countries less so. And it's a younger population. But I think the issue is this just goes to highlight the degree to which this is not a public health crisis anymore. It's morphed into something else. It's morphed into something more familiar. I don't want to call it a garden variety economic downturn because it's not a recession, it's a depression, right? So in a depression, it's going to be the most vulnerable that are hurt the most, like in a recession. And it's going to be those countries that don't have reserve currencies, that don't have social safety nets, that don't have the ability to print money in the same currency oftentimes that their debts are denominated in. So this is going to be a huge deal for the emerging world. Also, of course, the emerging world is so dependent upon commodity prices, including in many countries, oil prices. It's just going to be a huge issue. I just saw Algeria is cutting their federal budget by 50% this year in response. On slide 26, I would just highlight to you, this is the expected trend in electrification. And there's a lot of small numbers on this chart, but I think the most important ones are that vehicles with no internal combustion engine are expected to grow from 1% of the market in 2017 and 2% in 2018, 2% in 2019 to 13% by 2027. That is battery electric vehicles. But actually, if you look at the hybrid vehicles, full hybrids and mild hybrids, those are thought to go from 6% in 2019 to 41% in 2027. So actually, the much greater growth is in electrified internal combustion engines, whereas I know that the battery electric vehicles get all of the attention. And as mentioned earlier as well, we see some threat to these forecasts because of the lower oil and gas prices. Now, governments are still continuing with their mandates for automakers to lower corporate average fuel economy standards or grams of CO2 per kilometer in Europe, or to sell a certain percentage of their vehicles being battery electric or hybrid in China, what they call new energy vehicle standards. So the government's probably they may relax it a little bit in recognition of the problem that automakers are in, that consumers are willing to pay even less money for these battery electric vehicles now. And demand will fall for these vehicles, but still the manufacturers will have to sell a certain amount of them to remain compliant with government regulations and avoid relatively onerous fines. So I think what that's going to result in is a lower profitability as manufacturers need to sell electric vehicles below cost. I'm going to skip through some of this stuff that I highlighted earlier about our preferring the aftermarket to dealers, to tires, to suppliers, to automakers, to rentals. I think that's probably all that this audience needs to know. Unless you're interested, we can address in the Q&A. But on page 39, before I turn it over to Rich, I did want to hit on these car sharing counterpoints, because we had differentiated ourselves from some of our competitors who thought that, robo-taxi is going to be taking over the world. Elon Musk, for example, said there'd be 1 million. He said in April of 2019, there would be one, he said for sure. So maybe not in 12 months, but 15, 18 months for sure, there would be 1 million Tesla robo-taxis on the road in 2020. So we're still waiting on the first one, let alone the millionth. But our message here is that the blue skies, fully autonomous, completely car sharing future scenario may not come to pass, or may be much more delayed than imagined. And even if it did come to pass, some popular conclusions about the implications seem off. Look, this is very important for dealers, because I remember when we first went out with GM, and they were talking about what autonomous could mean for them. This is before Cruise was formed, et cetera. They thought that the dealers could form the sharp end of the spear, and the dealers could be doing the cleaning and the maintaining of the vehicles, et cetera. And that morphed into something later where I said to General Motors CFO, I didn't hear anything in this presentation about Cruise. I didn't hear anything about the dealers. He said, yeah, we don't really see a role for the dealers anymore. So, as I mentioned earlier, when Hertz and Avis buy vehicles from General Motors, they don't buy them from dealers. They buy them from the factory. And that's the way that Waymo and Uber and Lyft are going to be buying vehicles in the future, or GM Cruise, et cetera. So if we were to move toward more and more percentage of the vehicles not being owned by individuals, but instead by these autonomous mobility fleets, that would carry negative implications for dealers. However, starting on page 40, we talk about why we're not so sold on that scenario. What is the scenario? Yeah, in the future, people won't own vehicles. Instead, it's going to be MaaS or TaaS, transportation as a service, mobility as a service. I'm sure you've heard those buzzwords. And the idea is that fleet utilization could improve dramatically, perhaps by a factor of 2. And if that's the case, you'd only need half as many vehicles, right? That's just fractions. We get that, et cetera. However, on page 41, we talk about why this doesn't necessarily follow. For example, utilization, it's difficult to double utilization during rush hour, for example. You can easily double it during the day. but what about when there are bottlenecks? Convenience factors. Many people like to have their own cars. What do you do with child safety seats and salespeople store things in their cars, et cetera? Various different cultural and luxury factors, status symbols, et cetera. On page 42, there's various different technological, regulatory, and cost factors, including, I think, the move from mechanically rotating to solid state LiDAR. LiDARs, laser radars, they still cost like $10,000, $15,000 per vehicle. We need to get that down to $1,000. It was thought that we would get there in the early 2020s. Now we're kind of hearing middle of the decade at best. Now on page 43, though, what I would say is that, okay, let's say we're wrong about all that, and the completely car sharing future, it does come to pass. Well, what does that mean for vehicle sales and production? So if you have, twice as much utilization of vehicles, you would only need half as many of them. So we see that as potentially true, but I don't see any negative implication for auto sales in that scenario. Just because you have half as many cars in the country doesn't mean you have half as many car sales, because you're going to be utilizing those vehicles twice as much, putting twice as much wear and tear on each individual vehicle, even if we drive the same amount of miles. But see, I think that in a fully autonomous, completely car sharing future, which I don't see as around the corner, we'll actually drive more because more people will be able to drive. Children could drive, the very elderly could drive, disabled people could drive, blind people could drive, drunk people could drive better than they do now. I think that the convenience of driving also, it will increase for the population that already can drive, causing us to drive more. The example I've sometimes given is, an investor in Connecticut told me that every 3-day weekend in the winter, he goes skiing in Vermont, but he won't go skiing in the Catskills. It's just not, his style. The mountains aren't tall enough or whatever. He says, he's tried 2-day weekends, but by the time you drive up there on Saturday, the sun sets early in the winter, and by the time you have to leave Sunday, it's just not worth his time. But he said, imagine though, if I could, brush my teeth and put on my pajamas and go to sleep in my car, and then, on Friday night, and then I just wake up at the foot of the mountain on Saturday. You got all day Saturday to ski, you got all day Sunday to ski, go out, get drunk on the town with your friends on the ski town, and then, drive home while you're sleeping on Sunday night and wake up on your driveway and, shower and go to work or whatever. So it'll be easier. And, if you can avoid, viruses, and you can avoid, getting, body searched as you walk through an airport transportation security administration checkpoint, right? And then also there's the phenomena of deliveries and deadlifts, shopping become more convenient. You can just order 1 or 2 things. So you use Grubhub, all those things. So I do think that we would drive more miles, and that would, we may actually sell more vehicles in a situation where we have half as many vehicles in the country in a completely car sharing future. So that's a very broad overview of the latest that's happening with the industry. And I did want to discuss where we think electrification and autonomous mobility may be going. I want to turn over to Rajat to talk about what some of these trends, including the most recent trends in 2020, mean for auto dealerships, and then we'll take your questions.
All right, great. Thanks, Ryan, and thanks everyone for having me here. A really good segue into, the dealerships and, what just Ryan mentioned about autonomous. All great for, like maintenance, parts and services, like, for the dealer business model. So, anyways, I'll start here, with what's going on recently in the industry, what we have observed, the trends coming out of the first quarter reports, etc. So clearly, on slide 45, I'll start, like the sales recovery has started to happen clearly. April, the first week of April, last week of March were probably, the weeks that had the deepest decline year over year in sales. And since then, we have noticed a recovery happening, and in some cases, pretty sharp recovery. The latest feedback we have gotten from, our channel check suggests that sales in early May are down just 20% year over year versus down 50 to 60% here in early April. The sharp recovery here seems to be, being driven by some relaxed shelter-in-place orders, one by one in different states, and then also, a lot of OE incentives that have been put out there, 0% financing, payment deferrals, and like 90-day payments and things like that. So, Clearly, the industry has come together here to be able to drive demand. We think all of this could continue into June as well, like late in May here and into June as well. Again, driven by a lot of pent-up demand from March and April, and then also continued incentives from a lot of the automakers. So we do expect the trend to get better. The trajectory into the second half of the year, however, remains uncertain. As the stimulus checks start to roll off, unemployment is still pretty high. The shape of that recovery is also important. A lot of industries here in the country might have to change permanently. There could be some job losses in certain sectors that could end up being permanent. So it might take a while for unemployment levels to recover back to the levels we had seen earlier this year, late last year, which were like at record low levels. So, and as we have seen in the past, overall vehicle sales have been closely correlated with unemployment levels. So there is some uncertainty here with regard to the second half trajectory. So we watch for that closely. The other things to watch here is, as Ryan already talked about, like as these OEMs start to restart production, like how quickly they're able to get back on track fully. The overall global supply chain, needs to come together to be able to do that. Depends on when Mexico starts and Canada starts. So all those are also factors to keep in mind to make sure that the inventory lots at these dealers remain filled. And then in the second half, the other thing to watch for is obviously cash for a program similar to the cash for clunkers that we saw back in 08, 09. That could also drive some demand, drive people to the dealership. So that's another thing to watch for here in the second half. Beyond the current crisis period, there are a few long-term factors to keep in mind that might have actually changed through this crisis. Preference for personal transportation, from rideshare, reduced public transportation going forward, for at least a period of time. All of this could provide some downside support to car sales in the future. Again, new vehicle sales, which I just talked about, is a declining portion of dealer gross profit. It's less than 20% now, just 15% of overall gross profit in some cases. So not the big profit driver for dealerships anymore. So I want to focus on the used vehicle side of the business. Clearly, this has been an increasing focus for a lot of the dealerships, for a lot of the franchisee dealerships over time, and particularly the public franchisee dealers that I cover from an equity perspective, like Asbury, Lithia, AutoNation, Penske, etc. So used vehicle demand has actually recovered much faster than expected, similar to new vehicles, and it went down deeper and faster than the new vehicle side, and it has recovered faster than the new vehicle side as well, with some dealers that I have spoken to citing sales down just in the teens year over year, which is pretty impressive. Payment deferrals and a lot of CPO programs and offers have helped stimulate this demand, which I think is positive. Like strong programs on the CPO side, competitive incentives, are also, stimulated demand here. And particularly with a lot of off-lease volume likely to enter the market, I think this is important, and it is likely to be a key driver of used vehicle sales going forward. However, on the profitability side, there is some uncertainty. There has been a wide variety of strategies being deployed by the franchise dealers. Obviously, this is going to be a temporary impact, but again, something to keep in mind as in terms of near-term profitability. A lot of dealers have taken actions to clear out inventory quickly, taking a hit to profits in April, late March, in order to conserve cash, while some have actually decided to wait out for things to recover, and they have actually benefited from that because retail prices did not end up falling as much as wholesale auction prices. So for some that have actually waited out here into like May and June, May and potentially into June, not everyone can actually do that. The dealers that are well positioned from a liquidity perspective, from a good balance sheet perspective, may have more capacity to wait out here for demand to recover in order to liquidate those vehicles, versus some who are more capital constrained might have had to liquidate those vehicles at throwaway prices. So we might see some wide range in terms of profitability on the used vehicle side. But either way, I do believe a lot of this is likely to prove transitionary in nature, and the spreads that the dealers are making should recover, in 3Q and the fourth quarter as well. Just moving to the next slide here, slide 46. The key driver of profitability for dealers in the recent past and likely to be going forward has been parts and services. I mean, it makes up 50 to 55% of gross profit for a lot of the dealers. So clearly an important avenue for growth and important focus area for a lot of the dealers. However, this revenue stream for the dealers hasn't been that resilient as it was in 08-09 during the current crisis, because back in 08-09, miles driven did not fall off 30-40% as you've seen right now. They were down probably in the low single digits year over year. So the parts and services side of the equation for dealers is still pretty healthy, and actually helped a lot of the dealers generate really good free cash flow during that time. However, this is unlikely to be the case this time. Again, miles driven is down significantly due to shelter-in-place orders, and this is going to have a significant impact to profitability in the near term. And at least based on our conversation with the dealers, the recovery on the parts and services side of the equation has been slower to come versus vehicle sales. So this is going to be interesting to watch, and as a result, the overall headwind or the overall hit to profitability during this crisis, albeit for a very shorter period, is likely to be higher and more deeper than what we saw in 08-09. But again, if the economy does recover quickly in the second half, I mean, all of this should offset that. Again, like beyond 2Q, beyond the current crisis period, certain things to keep in mind here in terms of miles driven, areas like work from home, telecommuting increasing, unemployment potentially taking time to recover, are things to keep in mind here in terms of, just miles driven overall, and, what that could, how that could impact the parts and services side of the equation. Although there are some offsets here clearly, from lower gasoline prices and, reduced public transportation that might still, help maintain a healthy level of miles being driven out there. On the really encouraging side, finance and insurance, gross profit per unit there remains pretty healthy. It has remained pretty resilient through this crisis period, with penetration actually increasing for some as well during this period. Our conversations suggest that penetration levels remain really strong, both on the new vehicle and the used vehicle side, and this has remained strong even for the digital or online transactions that are taking place, at least for a lot of those who have strong capabilities on that side of the equation. However, with used vehicles probably recovering faster and growing better than the new vehicles, we might see an impact to the overall mix. But again, this should prove transitionary as we move into the second half and into next year. Moving to slide 47, one thing that has been a clear indication here, which I wanted to spend some time on, is this crisis has accelerated the transition to online channels. The unit economics on the online side are seemingly similar to what's happening in store, which I think is a key positive. Again, one thing I wanted to highlight is the industry was slowly transitioning towards digital retailing and buying vehicles online, though the pace of penetration hasn't really picked up enough as we would have thought. But this crisis has accelerated the shift in that direction. For the public dealers out there, anywhere from 10 to 25% of the sales in April were actually taking place online, which is pretty impressive. and at least 50% of the transactions were being originated online, even if they were being completed in store. And clearly, we have seen the benefit of this in the used vehicle space. Look at online only retailer Carvana, where sales are actually up 20 to 30% year over year in early May. So clearly, having that online capability, having a slick purchasing process does benefit. The OEMs have also taken many initiatives on this front, to drive this shift towards online, with advertising campaigns and incentives at the same time. So the whole industry seems to be coming together, to drive this shift. The key challenge or differentiation going forward for the dealers is going to be able to provide the right type of financing, provide the right type of options, providing a variety of options online for the consumer to select and do a lot of the product selection online. I think that might prove to be a big differentiator for the dealers going forward, and something to watch. We also think this shift towards online is likely to drive some consolidation in the space, particularly on the independent use side, where some of the smaller dealers might not have enough capital to invest in these initiatives, or be able to be fully equipped to drive online retailing. Just going forward, some other things, other themes that we have seen through this process. A lot of dealers have taken some aggressive actions in terms of cost-cutting measures. The public franchisee dealers have furloughed anywhere from 25 to 55% of their workforce. And while some of these actions, do seem to be permanent in nature, as a lot of them have said that the restaffing levels at these dealers are likely to lag the recovery in demand. So I think what's going to happen here is this crisis and the actions the dealers have taken to control costs might just ultimately, lower the overall cost structure for these dealerships and make them more efficient over time and drive higher throughput from a smaller sales force over time. And overall, actually drive better unit economics. So, as I said in my first slide, my introduction, that the dealers overall, in my view, are likely to emerge stronger and more efficient coming out of this crisis. One other thing I would point out from a P&L perspective, floor plan expense, clearly a material tailwind to near and medium term earnings. The 1 month LIBOR, which is used to determine the rates of this floor plan financing, has literally collapsed. It's almost at 0% right now. So clearly a pretty nice earnings tailwind going forward. Just last thing I want to highlight here for the publics and for the industry in general. From a balance sheet perspective, most dealers still remain in cash preservation mode because there still seems to be some uncertainty around the recovery in demand or what the shape is going to look like here in the second half and into next year. So a lot of the companies are approaching this with caution. A lot of the public dealers, Group 1 Automotive, for example, Penske Automotive, they have cut their dividend. So clearly, they are being conservative with respect to their liquidity and their balance sheet position. And I think coming out of this crisis, we do believe that those that have a better balance sheet position or a better liquidity position are likely the best position to take advantage of the recovery, whatever shape that might take, and again, and also take advantage of the transition to this omni-channel retailing approach, which is like digital, express pickup and things like that. So clearly overall, I think the industry has been changing slowly over time. There have been some slow structural shifts taking place, but I think this crisis does accelerate it in that direction. I won't spend too much time on my stock ratings here or the equity views, but just amongst the publics, I would point out that Lithia Motors, even though the stock has been pretty good through this period, has outperformed a fair amount through this crisis period, and that it remains a top pick given a solid balance sheet position, a good history of execution on mergers and acquisitions over time, and also solid execution on the core business as well. So I do think that company remains the best position coming out of this. The next couple slides here, I'll just provide a quick summary. No conversation about the industry is over, without talking about what Carvana has been doing. Clearly a pretty differentiated business model here. They participate in a fragmented industry on the used vehicle side. Plenty of good opportunity here, lots of opportunity to gain share. The largest player just has 2% share here, CarMax being that player. So a lot of advantages here, a lot of potential here to gain share, even not just for Carvana, but also the franchisee and the independent used dealers out there. The business model that Carvana has had is clearly differentiated. It's online only. They have a fully captive business, centralized reconditioning centers, proprietary technology. They are able to do quick background checks, provide immediate financing options. So clearly a business model that has that allows them to quickly expand into newer markets, grow market share in their existing markets, offer attractive pricing. The reason why they're able to do that is because they're able to leverage a pretty thin sales force. So they're able to offset the cost savings there on the sales force side, by providing cheaper pricing to the consumers. So clearly a business model that has gained a lot of traction, actually literally in my view has driven the industry in its direction, because you are seeing a lot of the franchise dealers and even the bigger players like CarMax out there, trying to replicate some of the things Carvana has been doing. Just moving to the next slide. I mean, something to keep in mind here, although the company does try to pitch itself as a technology company, it is not really one. I mean, it is not an asset-light company. There is a lot of heavy infrastructure deployment that goes on there. The company still owns a substantial inventory of vehicles. They do deploy heavy-duty trucks and trailers for vehicle transportation. So while the company does have a differentiated approach to reconditioning, I mean, they're still building out large IRCs or reconditioning centers, that do take up a lot of CapEx. So it's not necessarily an asset-light company, not necessarily a technology company. It is still a vehicle company, but it is being valued as such. So that's one area of differentiation here, or one area to keep in mind. But that's more from an equity perspective. The finance revenue or the finance business there is a substantial and increasing chunk of their profit mix. Roughly 35% of their gross profit comes from the gains that the company books on selling the loans. This is much higher than the competitors, other retailers, or even some other industrial companies that have a captive finance business. And this is clearly a potential risk, in a downturn, as we're seeing right now. There have been efforts to manage this, and it is a long-term competitive advantage. We are seeing that part of the business is seeing a substantial decline in profitability here in the near term. And it might as well, forever change the economics of that business, going forward. So clearly, there are some advantages here, and there are some disadvantages during the downturn. But as an offset, as I highlighted earlier, they seem to be selling vehicles at a rapid clip. I mean, they're the only company I know outside of Amazon or Google that is actually seeing their sales up year over year in this environment. So clearly shows the strength of their business model, but also some risks to keep in mind here. I won't go through the remaining slides. I'll just stop there as we're running over time here. And Ryan and I would be happy to take your questions. Thanks.
Any questions? I got a question for you, Rajat. What do you expect from the dealer standpoint, since everyone or majority all of the dealers switched from a person-to-person transaction to a digital concierge type transaction? Do you see that being more leveled out once things open back up? Or do you think that this new paradigm that we're in from a digital concierge selling point, sales and services, is here for a while?
Thanks for the question. I do think that there is going to be some sort of a permanent shift in that direction. I mean, I do expect people to start coming back to the stores and purchasing vehicles like they did before, but I also at the same time do expect a good chunk of the transactions now starting to start happening online or being even completed online, because there are two things here. I mean, it is, first of all, it might be convenient for the consumer as long as the consumer is comfortable doing it online. And I think till we have like a vaccine out there, and if till people are very comfortable, going out there and mingling at the dealership level, you're going to see this period making more and more consumers being comfortable doing the transaction online. So the dealers are actually preparing for the shift. They are making a lot of changes internally to be able to do that. And while there was a bit of an inertia in doing that over the past few years, I think this crisis has helped accelerate the shift in that direction. And keep in mind, like going forward, it does also help the unit economics for the dealer themselves to be able to do this. If the consumer is actually comfortable doing the transaction online, it is a more profitable transaction for the dealer ultimately overall as well, because you're able to drive higher throughput with a thinner sales force. You don't need the same number of F&I managers online if you have a good, robust software that's being deployed to be able to provide those products. So I do think like some of this is likely to be permanent, driven both by the consumer and from the dealerships themselves going forward. So yeah, I mean, like I do think it's here to stay.
What impact will the overall economic condition of U.S. unemployment have on new vehicle sales?
So we have done an analysis in the past that there is an extremely strong correlation to new vehicle sales with unemployment. Based on our analysis and based on our internal forecast, JP Morgan forecast on how unemployment levels might trend in 2Q and the rest of the year. Our models here do forecast that SAAR is likely to be between 12.5 to 13.5 million this year. So it's clearly a sizable hit, and we don't anticipate unemployment levels recovering fully by next year either, at least back to the levels that we saw in second half of last year and early this year. So it's going to be a stretch to expect SAAR levels even in 2021 to be back to 2019 levels. I mean, we do expect strong growth off of this year's levels, but it might take a couple more years for us to reach the levels that we saw last year. And again, that will be
I was just going to say, as Rajat mentioned, that U.S. light vehicle SAAR is the one metric that is most positively correlated, or rather the inverse of the unemployment rate is the metric that is most positively correlated with U.S. light vehicle SAAR. So that's very problematic for the current situation, and that is definitely factored into the draconian SAAR forecast that I mentioned earlier and Rajat just mentioned right now. The only nuance I would add to that is that I would say that in this downturn, at least so far, knock on wood, I may lose my job tomorrow, but the downturn so far appears to be concentrated in a little bit lower income employees, including those in the hospitality sector, those in the food service sector, et cetera. I'm sure you saw Jerome Powell the other day mention that 40% of households with average household income under $40,000, 40% of them have experienced a job loss in the last 6 weeks. Whereas, of course, in terms of the overall number of employees, it's been relatively less than half that. So that may be a little bit of a positive factor for U.S. light vehicle sales, just given that with the average selling price of vehicles now being around $36,000, $37,000, it is disproportionately middle and higher income workers that are buying new vehicles. Ford has told us, for example, that the average household income of somebody who buys a vehicle through Ford Credit, which is exclusively prime, which is about 90% of the market, is about $75,000 compared to the average household income closer to, around $52,500, $55,000. So we are very concerned about unemployment, but if there is a little bit of a silver lining to suggest it may not be as horrible as the headline figures suggest, we're hoping that that might be it.
This is a two-part. So what about the charging? Do you see dealers charging customers for pickup and delivery services over a certain mileage? If they're over a certain mileage, do you see fees incurring for that to increase, since this is going to be part of the new paradigm? And also with COVID, unemployment, et cetera, what do you think the effect on the franchise values will be?
You want to try that one, Rajat?
Oh, hey, sorry, I put myself on mute for a second. So just on the valuations here for franchise dealers, I think there would be some impact. There would be some attractive assets out there that might be attractive for some of the public franchisee dealers out there that are well capitalized. I mean, we do expect some correction to happen here in terms of valuation multiples overall. Historically, those multiples have been highly linked to the direction of SAAR overall. But there are other factors now to keep in mind in terms of like who is or who is not well capitalized to also take advantage of the transition to digital retailing and things like that. So those are the other aspects to keep in mind. So I do think like the valuation multiples will take a hit, and we could also at the same time see some divergence here, or between the well-run or the ones that are fairly poorly run, or do not have the bandwidth to invest or grow on the digital retailing side. So overall, I do expect a correction.
And the other part, do you see dealers charging more to doing the concierge services for drop off and pick up?
I do not see that happening, because at least the conversations that I have had, it seems to suggest that they're going to try to make the pricing pretty attractive at the same time, and try to because you are going to also at the same time see a lot of savings at the back end, because with online you're actually hitting more people, you're getting more throughput from your stores, so you do get some savings or unit economic savings from an SG&A perspective that they're happy to pass on like to the front-end consumer as well. So the conversations we have had suggested that there's not going to be any additional pricing or charges with respect to that.
Okay. All right. Well, with that being said, hey, thank you guys. Thank you, Ryan. Thank you, Rajat. Thank you, Ernest. And thank you, Chase. And thank you all for participating. I hope you guys have enjoyed the rest of your Monday. This presentation and the attachment will be posted on named.org later this evening or first thing tomorrow morning. I hope all of you guys wish a great day. Have a great day. And thank you guys. Have a good one.
Thank you.